Very good evening to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountants of India, I welcome you all in today's 127th CP program organized by AASP of ICI this council year. So this is today's is a 127 CP program, and we all are aware that we have conducted all the webinars relating to the various standards on auditing, as well as we have covered various sectors specific webinars also. So we have covered various sectors like education sector, healthcare sector, non-profit organization, as well as power sector. Today we are also going to take one very important another sector, that is the manufacturing sector. So that is why we have planned today's webinar on key considerations while auditing the manufacturing sector. So in order to tackle this, we are having with us very eminent and very learned speaker, C. Achal Jain. So on behalf of AASP of ICI, I extend my warm welcome to you, Achal on this Zoom platform as well as webinar organized by AASP of ICI. Achal welcome to you. I also welcome all the participants of today's webinar. And before we formally start, as Honorable Chairman and Honorable Vice Chairman of WSP, both are engaged in some other meeting. So I would like to start this webinar with the formal introduction of C. Achal Jain. C. Achal is a chartered accountant and BCom honors from University of Delhi. He is currently into practice with more than 17 years of post-qualification experience. Assurance and advisory practice of big four firms. He has considerable experience in providing trainings as well as various programs, seminars, webinars, as well as virtual CP meetings to the clients on India's IFRS US GAAP. He is an active speaker with the ICI for India's training programs and other programs, as well as significant experience in assigning clients across industry sector, manufacturing, real estate sector, the power sector, construction sector, service, software, media, training. As I already told, he has given so many lectures, so many seminars, webinars during COVID period also. He has conducted virtual CP meetings and webinars on various platforms organized by Institute of Chartered Accountants of India as well as various committees. So before we formally start and without wasting much more time, I request Achalji to please formally start the today's deliberation. Over to you, Achalji, please.
Sure. Thank you so much, Anilji, for this opportunity again, and thanks everyone for being here for this session. And I'm just hoping that this session is going to be, sort of enlightenment for everyone in respect of the areas that we are going to discuss. Along with this, I also request everyone if you can just also share some of your experiences around this sector that we are going to cover, or some of your queries or some of the challenges, so that after our session, once we have this discussion amongst all, we can also discuss some of the queries or the experiences that you would have shared. So I'll just move on to first of all understand briefly about the manufacturing sector. When we talk about the manufacturing sector, it's a wide domain as compared to any other sector. So when I say wide domain, means any company which is into some sort of manufacturing gets covered under the manufacturing sector. Now, this manufacturing could be related to anything. It could be related to the auto parts. That means if we talk about the automotive thing, that is something which will form part of manufacturing sector. So if we talk about the goods which are used for FMCG sector, if those are getting manufactured, that once again gets covered under the manufacturing sector. Similarly, if we talk about any sort of manufacturing related to metals per se, for example, if we talk about the manufacturing of steel, so to a certain extent, that also gets covered within the purview of this standard. So when we are going to speak about this sector, one can understand and appreciate that there are a lot of coverages in respect of various companies which are going to be involved. And that's why I believe that this sector is going to be very, very relevant for, in fact, everyone, because everyone must have dealt with the manufacturing sector during the course of their engagement at some point of time. So I'll just also share one presentation through which we'll just try to run this session. So let me just share this presentation with you. All right. So when we talk about the manufacturing sector, the first and the most important consideration which comes to our mind, we can process. I understand there was some audio problem. So I was just saying that when it comes to the manufacturing sector, the first and the most important point which comes to our mind happens to be the inventory, because this sector is dominantly governed by this inventory, or you can say that the key area in respect of the financial statements in respect of any such company is going to be inventory. And when we talk about inventory, it is not really limited to inventory as one of the line item in relation to the financial statements. It is all about the process of the organization, because it's a cycle. So when we talk about this cycle, we are basically talking about the procurement process, which is involved in respect of inventory, and then of course the conversion process through which this raw material or any other material which is procured, which is then processed and that is manufactured and then which is eventually sold. So over here, in respect of manufacturing sector, there is a great focus of the organization on this inventory piece. So the first aspect which becomes important for an auditor happens to be the understanding of this procurement process. See, when we talk about audit, in respect of audit, if we have to design any audit procedure, the first thing which the auditor needs to understand happens to be the organization, happens to be the industry. Because only and only when the organization or the industry is understood, the auditor will be able to just think through as to various relevant procedures which he is going to apply in respect of audit of that particular entity. And when it comes to the understanding of the entity, it can then be broken into various parts. And those parts happen to be the processes of an organization. So, in respect of the processes, let's try to understand as to what can be the processes. So, we can say procurement is one process in an organization. Similarly, sales and marketing is one process in an organization. Similarly, if we talk about capitalization, that is again one process. If we talk about payroll, that is again one of the processes of an organization. Similarly, the accruals. Yeah, so there are a lot of processes which basically drive the organization in respect of various activities which are involved. And we are now going to discuss one of the key processes in respect of the manufacturing sector, which happens to be the inventory, or you can say the procurement process. Now, why is this understanding of the process important for an auditor? Let's try to understand this. See, when you go to the client place and when you start performing an audit, the first thing which we need happens to be the audit procedure. Means we need to understand as to what audit procedure we need to perform. So now, if we have to apply any audit procedure in respect of any item, how do we design that audit procedure? Only and only when we have an understanding of the area which is going to be audited. And along with that understanding of an area, we also need to understand as to what could be the risks which are involved in respect of that particular area. And along with the understanding of the risks, we also need to understand as to what is the management trying to do to address all of those risks. Okay, so basically it's not only about the understanding only, that means in respect of the functioning or in respect of the activities, but the auditor also needs to understand the risks which are involved and the controls which are involved. So let's try to understand with the help of an example as to what could be the risk, what could be the activity, and what could be the control which we are discussing over here. Say an entity purchases raw material. Okay, so that's an activity for an entity. But what could be the risk? that the purchase manager has raised an order, purchased the material for which the invoice has also been received, but the goods, the material have not reached the organization. So physically, the goods have not been received. So is this a risk? Definitely, there is a risk that the material which has been purchased has not been physically received. So how do we address this risk? Now, as an auditor, for anything to be done, for any audit procedure to be applied on this, first part which remains important happens to be the understanding of the management control in respect of this risk. So what is it that the auditor needs to understand? Auditor needs to understand what is the management trying to do to address such type of risks. Because one may say that how is this relevant, because it's a very basic thing. How is this going to be possible? But is this really a risk or not? If the audit is involved, definitely it's a risk. And who has the responsibility to take care of all of these types of risks? It is the management, because all of these processes, all of these risks, all of these controls happen to be the responsibility of the management. So the first thing which the auditor would ask the management will be about the controls which could be in place in respect of that particular risk. So say for example, the auditor talks to the management and asks for the risks, which is asks for the we have a control that till the time the material is not physically received, which is tracked by, say, for example, the security guard at the gate premises, and then eventually the store manager who will record the physical receipt of the goods. Only and only then such purchase will be recorded, such purchase will be accounted for. Now, is that a control? Definitely, it's a control. And is that control taking care of such type of risk? The answer is yes. This control is taking care of the risk which is involved in respect of this process or in respect of this activity. Now, similar to this, in respect of various activities, auditor needs to understand the risks which are involved, and against those risks, the controls which are in place. Okay, which is also very commonly understood as RCM, risk control matrices. Okay, so for the organizations, in fact, if we talk about the large organizations, we have this IFC report applicable on them. Now, in respect of IFC, what is it that we try to do? We look at the RCM in respect of an entity, and in respect of RCM. So this is something which the auditor would want to do. Now, this was about an understanding of what is it that the auditor will perform in respect of the process which is there, plus why is this process really relevant for the purposes of an audit. So we understood with the help of this example that yes, it's important to get an understanding of the process and also the understanding of the risk and the controls which are involved. Now, let us suppose we are in a situation wherein the management has got the controls in place, but all those controls are only there on the paper. Means the management has a good RCM matrix, they have a good documentation of the processes, but are those processes, are those RCM, are those controls really operative, or are those only a document which is there in the office of the client, or that is only sitting on the table in the form of a piece of paper? So that is again one area which the auditor needs to take care of. And how is that really taken care of? By doing the control testing. So that means all of these controls which the auditor would understand or which the management must be having in place, auditor needs to identify, and, and auditor needs to check, auditor needs to test whether those controls are operating effectively or not. And how is that done? That is done by testing some of these transactions in respect of these activities. For example, the activity we talked about that was in relation to purchase of the raw material. So once this activity, once this process is understood, what is the next step that the auditor will perform? The auditor will check, auditor will test the operative effectiveness of the controls. Now, once this testing is performed, auditor will come to a conclusion. So it's not about the end of the audit, it's about the beginning of the audit, or you can say it's all which is going to form a planning in respect of the audit of this particular area inventory. Now, once this testing of control is performed, what is the next step which the auditor would want to do? Auditor will then form a conclusion that whether the operative effectiveness is there in respect of those controls or not. Let's try to understand this situation once again with the help of an example. So if we talk about an organization wherein the controls are effective, means the controls are good, the management is quite focused in respect of implementation of controls, their operative effectiveness of controls. Yeah, so there are good SOPs in place. So what will happen? The comfort level of the auditor will definitely increase. The comfort level of the auditor will increase. Why? In respect of the audit, or you can say in respect of the substantive testing which the auditor would want to perform. Yeah. Now, as compared to this, if we think of an organization wherein the controls are not operating effectively, means the controls are missing. Okay. At a lot of places, what do the auditor find? That there are a lot of errors. And what is the reason of those errors? That the controls are not in place. So, what will be the result of this? This would result in a decreased comfort level of the auditor. Means the comfort level of the auditor in respect of such type of entity will definitely go down. Yeah. And this will basically have an impact on the extent of the testing of the auditor. So now one can rightly understand that with the help of this control testing, with the help of this understanding of the process, what is going to be the impact on the audit? The extent of substantive testing is going to be decided. Why? Because in respect of an organization wherein the controls are operating effectively, the auditor would want to perform lower testing in respect of some of the areas. And in respect of an organization wherein the controls are not operating effectively, auditor would want to definitely increase his testing. Yeah, so this part therefore becomes very important in respect of audit of this particular area or any other area. And when it comes to the decision relation in relation to the key areas, which are also termed as the significant risk areas in respect of an organization. For example, if we talk about inventory, which in most of the cases should be considered to be a significant risk area. So in respect of those areas, the extent of testing of an auditor would generally be higher. And that's why it's very important at the first place to understand about the controls, whether those are in place or not. Yeah. So this is something which is going to be the first part, and I would say which should be the most important part in terms of approaching the audit, particularly in respect of the key areas, or you can say the significant risk areas. Now, when it comes to the inventory, now in respect of this inventory, there are various assertions. Okay, so if we talk about the audit is all driven by various assertions which are involved in respect of that particular area. Now, what are these assertions? We all understand about the assertions. So if we talk about cutoff, that is one assertion. If we talk about valuation, that is one assertion. If we talk about existence, that is one assertion. Yeah, so there are a lot of assertions. Now, If we talk about one assertion, that is existence of the inventory, means whether the inventory actually exists or not. So what is it that the auditor would perform as an audit procedure to test this assertion in relation to the existence? In that respect, the most important, and I would say the only procedure which happens to be the relevant procedure in case of an inventory is physical verification. Yeah, so we all understand, and in respect of these organizations that we audit, so what will happen every year at the year end, we hear about this, and we actually perform the physical verification of the inventory. So now we are going to talk about this particular procedure because this is the most important procedure when it comes to the audit of inventory. And in respect of manufacturing sector, this procedure becomes all the more important. Why? Because there are various reasons around it. We'll discuss as to why this is all the more important in respect of a manufacturing sector. So now, what is this physical verification? Physical verification simply means that the auditor will go to the client place and will physically verify the inventory. Generally, this procedure is performed at the year end. Why? Because in respect of the financial statements, in respect of the balance sheet, the value of the inventory, which is going to be reported as at the reporting date, is something which can be tested by performing this physical verification. Now comes the question as around this physical verification, that is this physical verification required only at the year end, or there are some ways through which this physical verification may not be performed during the as at the year end. So now, in respect of this physical verification, I would say it's always important and it's always good to perform this physical verification as at the year end. Okay, that means it could be around 30th March, 31st March, or 1st of April, or maybe the first week of April, depending on the size of the organization and depending on the quantum which is involved. Okay, but if we talk about some of the large organizations wherein the quantum is significant, in respect of those organizations, at times we see that it's not possible to physically verify inventory during the year end only. Yes, so if we talk about large organizations, okay, so now in respect of those organizations, it may become practically impossible to physically verify as at the year end only. So that's why some of the organizations may have this process of performing the physical verification of an inventory on a cycle basis. Maybe during the year, every quarter, what they are doing is that one part of inventory. So let's suppose they have got 4 types of inventories. So one type of inventory is getting physically verified during a particular quarter. The other part is getting physically verified during the second quarter. Other part is getting physically verified during the third quarter, and so on. So this becomes a sort of rolling cycle, which is again okay to be done. But at the same time, it is very, very important to understand that whenever such activity is performed, it's important to make sure that the roll forward procedures are performed. For example, now let's try to understand as to what do you mean by roll forward procedures. So now what you generally find is that the physical verification of inventory, let's suppose, is performed on 3rd of April. Okay, so year end is what? 31st of March 2023. And when is the physical verification performed? 3rd of April 2023. Now, in this respect, what do? Even though we have physically verified as an auditor, we have physically verified the inventory as on 3rd of April, but we need this information, we need this data in the financial statements as of 31st March. So that's why we need to perform a procedure wherein the physically verified inventory as at 3rd April is rolled back to 31st March. And how is that done? By doing this reconciliation. So the numbers which are there in the books of accounts as at 31st March and the number which was there as at 3rd April when this is physically verified, these are required to be then tied. Okay, so the numbers are required to be rolled back. Similarly, if let's suppose this physical verification is performed on say 28th of March or say 25th of March. Why? Because the quantum was huge. So you started on 25th of March. So what do? We are required to roll forward this so that we reach up to the number of 31st March. So this is again a very, very important aspect in relation to physical verification of inventory. Now, another challenge which arises in respect of some of the companies, or you can say some of the entities, while performing the physical verification, happens to be the nature of the inventory. Now, the nature of inventory in respect of an organization which is into manufacturing sector may not be such that we can just simply go and count the inventory. Okay, it's not going to be such always. For example, if we talk about the raw material, okay, so the nature of raw material could be such that it's not something which is available in terms of number of pieces. It is not something which is available in cartons which can then be tested. Okay, so what is it that we would want to do? We would just want to go count it, and that should be our physical verification. So this is something which an auditor would want to do. But let's think of an organization, say for example a company which is into manufacturing of steel. Yeah, so the material which they will have, so you cannot just simply go and count it. Okay, why? Because the nature of inventory is completely different, and the way this inventory is placed, I'm not only talking about the quantum, but the nature of inventory could be such that it's not easy for an auditor to really physically verify that. Why? Because it may involve some sort of expertise to understand the physical verification, or to understand as to how that can really be physically verified or not. Now, in that respect, there are two options which are available. Let's discuss about those two options. So let's think of an organization wherein the nature of inventory is such that the auditor may not have the expertise to physically verify that. Why? Because the nature is quite complex. Now, in that respect, what may happen is maybe the management has got the experts. So what could the management say? That we have the team of experts and we will get this physically verified, and you as an auditor can come and participate in that physical verification process. Now, is that an acceptable practice? The answer to this could be a yes as well as no. Why? Because again, it's something which is judgmental. One needs to take care of the aspect, one needs to understand the complexity which is involved in respect of that physical verification process. Okay, now in that respect, if let's suppose auditor doesn't have the expertise, so when I talk about the auditor, we are just talking about the audit team which is there on the ground, including the audit partner which is there. So if they believe that they are not really the expert, so what can they do? They can engage their own expert in respect of this physical verification process. Now, one may really think that only for the purposes of this physical verification or this stock take, will it be appropriate to engage an expert? The answer is again yes. Why? Because this is again something which the auditor will have to decide. This is something which they will have to plan, and this is all judgmental. So we cannot say that every time the answer to this question will always be yes. This is something which the auditor needs to think through. Why? Because it's one of the key areas, it's one of the key items which is sitting in the financial statements, and for which the audit procedure, and that is physical verification, again happens to be very, very important. Yeah. So that's why a lot of planning, a lot of thought process is required to be applied, and accordingly, this procedure should be performed. So I'll just briefly touch upon these two aspects which I've discussed with you. One was about the involvement of the management expert, and second was about the involvement of the auditor's expert. So let's talk about a situation wherein the management has involved an expert, but the auditor believed that he is not required to involve his own expert. Okay. So now in this case, when the physical verification is getting performed, wherein the management's expert is involved, now what will be the requirements on the part of the auditor? Now, in such a scenario, will it be good enough that the management expert comes and provides a kind of report from his side that yes, this physical verification has been performed and this happens to be the quantity, wherein the nature or everything, every aspect of the inventory is explained, and auditor just simply documents that report in his file and doesn't perform any other audit procedure? The answer to that will be unknown. Why? Because one has to understand that who is responsible for audit. See, when it comes to the financial statements, when it comes to the financial reporting process, whose responsibility is that? It's that of the entity. Okay, if we talk about the management, if we talk about those charged with governance, it's all about entity. But when it comes to the audit, whose responsibility is that? Audit is the responsibility of the auditor. So that's why auditor has to make sure that even if the management's expert has been involved, he is involved in this process and he reaches to a stage wherein he becomes comfortable as regards the physical verification which has been completed, or we can say as regards the existence of that inventory as at that particular date. Otherwise, it's going to be a significant miss in terms of the audit procedure. Okay, now let's talk about a different situation. So now what is this different situation? Wherein the management has involved an expert from their side and auditor has also involved an expert. Now, in such a case, when the auditor has involved an expert, can the auditor say that because the expert has been involved, okay, and that is the expert of the auditor, so that's why no other audit procedure is required to be performed by the audit team or the audit partner? The answer to that again will be a no. Why? Because in such a case, once again, one needs to understand that who has the responsibility for the audit. See, the audit's responsibility happens to be that of the audit team, or one can say the audit partner. And that is why, even though that team of expert is going to be the part of the audit team, but ultimately who is going to be the responsible person for the audit of the financial statements? It's going to be the audit partner. So that's why, in respect of any of these experts who are involved, and despite the fact that the audit partner may not be an expert in that area, it's important that he stays involved in this entire exercise, in this entire process. He understands the complexities which have been involved. He understands the challenges which might have arisen, the ways through which those challenges may have been done away with, and he should also make sure that he gets the comfort over this entire exercise or over the procedures which have been performed, because eventually auditor, or I would say the audit partner, cannot write in his report that this particular activity was performed by this team and that's why I'm not responsible for this. That's not possible. Yeah. So that's why all of these aspects become very, very important. And please understand the fact that in respect of this inventory, particularly in the manufacturing sector, there are going to be a lot of challenges. So that's why it's very important to stay involved in respect of all of these activities. Another area which generally bothers the auditor happens to be the work in progress. Now, work in progress is what? So say for example, some material has been procured and which is in semi-finished stage. Why? Because the finished good has not been generated. So this semi-finished stage or this WIP stage is something which is also going to form part of the financial statements in the form of an inventory, because that is also going to form part of an inventory. Now, when it comes to the physical verification, it's easy to physically verify the raw material. It's easy to physically verify the finished good. But when it comes to the work in progress or something which is in semi-finished stage, at times this may also trouble the auditor quite a lot. And that is where this understanding of the process which is involved in respect of various activities as regards the manufacturing process also becomes very important on the part of the auditor. And accordingly, the auditor will be able to decide and design his procedure. So when I talk about the audit procedure, it's all about the audit procedure in respect of physical verification of this work in progress. So that becomes very important as to what are the stages and at what stage, what percentage of completion is decided and how is that really decided. So all of these aspects become very important on the part of the auditor to check and also to make sure that those have been tested, at least on a sample basis. Because one cannot say that if, let's suppose, a particular item is 40% completed, so the auditor can just go and take this certificate from the management that this is 40% completed and hence this has been considered as 40%. No. So this has to be backed with something. There has to be something which should form part of documentation of as to how this semi-finished stage has been arrived at. Yeah. So this is very important process, or I would say very important area in respect of an audit of inventory. Next comes the part around the valuation. Now, valuation is eventually the thing which is going to be recorded in the financial statements. So when I talk about the valuation, so we are basically talking about the amount which is going to be recorded in the financial statements. And for this inventory, valuation once again is another very important area. Yeah. Now, when it comes to the inventory in terms of its valuation, let's try to understand as to what will form part of valuation. So first is going to be the cost of the material, for which what is it that the auditor would want to perform? Auditor would want to perform the procedures. Okay. The procedures around what? The procedures around the purchase, around the procurement, okay, which are not going to be very complex, yeah, which are going to be relatively easier, because purchase or the procurement in terms of their testing is not something which is going to bother quite a lot. But yes, that's a process, that's an activity which is important. The other aspect which becomes important happens to be the cost allocation. So let's discuss about the valuation of inventory. So if we go to the requirements of the accounting standards, what does it say? That any cost which is incurred up to the stage the inventory becomes ready for sale. Okay, inventory becomes ready for sale is going to be loaded to the cost of the inventory. Okay, so I've just used a very simple term to understand the meaning of this cost of inventory. So now, what are the costs which could form part of inventory therefore? So one is going to be, of course, the direct cost. Direct cost will be about the purchase cost, wherein some sort of discounts could be involved in terms of their adjustments, which are going to be tested by the auditor. Or there could be some refundable taxes, there could be some non-refundable taxes. which will all form part of the direct cost. Along with those direct costs, there also comes a component which is called as directly attributable cost. Now let's try to understand what is this directly attributable cost and how do we really audit this directly attributable cost, because this happens to be again a challenging area in respect of audit of valuation of inventory. And in fact, I'm sure you must be able to relate to this. Every organization which you look at, which is dealing into valuation of inventory, okay, so that means I'm talking about the manufacturing sector. The valuation aspect is something which bothers every management, and there are a lot of problems which are involved in this. And there is a reason behind this. Valuation, which is captured by most of the organization, happens to be a manual exercise. Okay, so that's why one challenge which is involved is definitely the manual intervention. Okay, because the manual intervention is there, so that's why there are risks of errors. Yeah, why? Because human error is definitely possible. So it may be unintentional, but human error is possible. But one area which is called as directly attributable cost is important for an auditor. Why? Because in this case, human error, which could be intentional, is also quite possible. So that's why the auditor needs to focus on this area. Now, what is this directly attributable cost? So when the inventory is getting manufactured, so we are talking about finished goods. So one cost is going to be the raw material. Other than raw material, let's think about some of the costs which will be involved. The labor will be working on this. Yeah. So manpower will be involved. Now, who are going to be the manpower? The factory workers. So in a factory, the workers who are working on this production process. So their cost, where is that loaded? That is loaded on the cost of inventory. Correct? Now, this factory where the production process is taking place could be on rent or could be owned by the organization. If that is on rent, then this rental cost of the factory is what? That is again a directly attributable cost, which should be loaded to the cost of the inventory. And if that is owned by the organization, if this factory building is owned by the organization, then what will happen? Depreciation must be getting charged on the factory building. Yeah. This depreciation charge on the factory building is once again required to be loaded on the cost of the inventory. Why? Because this is once again attributable only to the production process. So that's why this should also form part of the cost of the inventory. Similarly, there could be some consultants who are specifically working on this production process. Or there could be any other cost. So if we talk about small repair and maintenance, if we talk about any other production cost, which are directly related to the production of the inventory. Now, what do you do with that? That is allocated to the cost of the inventory. Now, in this cost allocation, which basically decides the valuation of the inventory, there are a lot of challenges. Let's try to understand some of the challenges and what are the ways through which we need to manage those challenges as an auditor. Now, the first thing is that we need to make sure that this master sheet, okay, whenever this cost allocation is done, so company will do this cost allocation as a one-time exercise. So they will decide that these are the chart of accounts wherein all of these items form part of the production cost. So it becomes it becomes important for the auditor to go through that complete allocation and to understand and make sure that yes, this cost actually forms part of the cost of inventory. Why? Because this is directly related to the production process. Now, let's just think about some of the costs which could be there. So if we talk about the marketing cost, now can the marketing cost be a part of the cost allocation? The answer is no. Why? Because that has got nothing to do with the production process. Similarly, if we talk about the corporate costs, okay, so let's suppose there is a company which has got a corporate office and they have got two plants. Now, in respect of this corporate office, the costs which are there, can those costs be loaded to the cost of the inventory? Once again, be no. But in this respect, at times, what do you see? That some of the organizations do load some component of the costs on the cost of the inventory. But there has to be a reason for this. And that is where the understanding of this process becomes important on the part of the auditor. Auditor needs to understand and decide that is there any team, is there any person who is directly working on this production process or not? If at all he is not directly working, is that working, say, partially in respect of that production process? And if that is partial, then how do we decide the cost element in respect of that person, which can then be loaded on the cost of the inventory? So all of these aspects become very, very important. Why? Because one must understand the fact that the moment we make the changes in the cost allocation, so what will happen? So the cost of inventory will change. Yeah. And this happens to be a risk area. Why? Because if, let's suppose, the client would want to, or a company would want to manipulate, okay, so how can they do this? They can just increase the cost of the inventory, or they may decrease the cost of the inventory, depending on the intent which they may be having. So if, let's suppose, they want to increase the profits, so what can they do? They can just increase the inventory. And if they want to just decrease the profits, so they can definitely decrease the inventory. So that's why the audit of this valuation of inventory happens to be an extremely important area in respect of manufacturing companies. Yeah. All right. Another aspect which becomes relevant and which one may see is quite a few times ignored, but which is again important, happens to be the understanding of stores and spares. So now, if you look at the requirements of the accounting standard, if we go by the requirements of the accounting standard, it says that stores and spares, okay, which are used in the production process, but which are expected to be used for more than one reporting period. Now, what is this more than one reporting period? 12 months. Meets the criteria of being a PPE. What is PPE? Property, plant, and equipment. And I'm sure you are familiar with this property, plant, and equipment. This is nothing but the fixed assets, the new terminology which we use for the fixed assets. So now, if we look at the practices, okay, so that is with or without Ind AS, because this is not really relevant. Why? Because the Indian GAAP has also changed in respect of the requirements of PPE. So if you look at the requirements, one has to evaluate the nature of stores and spares along with its useful life. Why? Because this expected to be used is what? This is nothing but the useful life in relation to stores and spares. If you look at the practices, organizations ignore this at times. And generally, what is the practice that you find? Generally, these are recorded as inventory items, which may be okay, which may be all right. But let's think of those items which are expected to be used for more than 12 months. So what do you do? As an auditor, it's important to make sure that this particular area is audited carefully. And how is that required to be performed? Because as an auditor, can we just go and go and test each and every item in respect of this stores and spares or any other item? The answer is no. That's not really possible to audit each and every item. So on a sample basis, so what can the auditor do? First of all, they can understand the process of the organization here. So how do they really classify this? or do they have any mechanism for this classification at all or not? Yeah. So if that is in place, then definitely on the population, some of the large ticket items or some of the items on a sample basis, okay, any sampling methodology which the auditor would find appropriate in that situation will have to be applied, and accordingly this particular area also needs to be tested. Otherwise, let's try to understand what is the impact. So one, definitely the classification goes wrong. The other aspect could be again on the P&L. Why? Because one area which needs to be classified as PPE and therefore depreciated is not getting depreciated, and which is actually forming part of the inventory. Okay, yeah. So these are the important areas in respect of inventory, one can say, when it comes to the manufacturing sector. Now, continuing further on this, and an area which is really linked to this happens to be the COGS. Now, this is again one area which is significantly ignored when it comes to the audit of the manufacturing companies. And there are reasons for this, because at times we find it difficult to audit this particular area. But one must appreciate the fact that when it comes to the manufacturing company, the key item in their statement of profit and loss happens to be what? COGS. Yes or no? So that's why it's very, very important to make sure that this item is appropriately audited. When it comes to the appropriate audit, which it's all about the extent of the testing which is involved. Now let's try to understand as to what are the challenges. So the first challenge happens to be the understanding of the audit procedure. Okay, so one may think that when it comes to the COGS, what can we really do? So one may say that we can just simply compare the amounts of 2 years, means the current year amount is compared to the previous year, and that is all. Okay, that is all done. But is that the only procedure which one may perform in respect of the audit of cost of goods sold? The answer to that will definitely be no. Why? Because this is again a significant area on which just a comparison of two numbers cannot be considered to be good enough when it comes to the audit of that particular area. So now, in respect of this area, let's think of the audit procedures, and let's try to understand as to what is going to be the relevance of those audit procedures and how should we really perform those audit procedures. Now, what is this cost of goods sold? Cost of goods sold basically talks about the cost of the manufacturing, yeah, or we can say the manufacturing cost, and wherein this manufacturing cost is limited to the material which is involved. Okay. Now, for this to be audited, one must understand the split of this cost and how is this cost really determined. Yeah. So now this cost is basically determined on the basis of the material which is involved in this entire production process. So now one can say that let's suppose the organization has got 20 products. Okay. Now out of these 20 products, one can say these are the 5 top products. Yeah. Now for each and every product, organization must be having a BOM. BOM, we all understand. What is BOM? Bill of material, which is nothing but a composition which the organization will be having in respect of manufacturing of that particular product, which comprises of various items which will form part of that cost and in various proportions, and which generally remains unchanged. Now, if one were to audit COGS, it's very important to audit the BOM. It's also important to understand BOM, because to audit this, it's important to understand. It's important to understand that first. It's important to understand the split first of all. It's important to understand as to what will form part of this BOM. Okay, once that part is understood, so now if we talk about, say, a BOM which has been taken in the current year, so what is the audit procedure which the auditor would want to perform? That if this BOM is there and this was also there in the last year, which has not changed in terms of their composition, but still the cost is increasing. So what could be the reasons for that? The prices of the materials have increased. Why? Because the composition is same, so the quantity remains same. Because what will comprise of this cost? Quantity multiplied by rate. Correct? So now if the quantity has remained unchanged, what could have changed which would result into decrease or increase in the cost? It has to be the rate. And what do you mean by rate? It has to be the purchase price. So that means we need to pick up these bombs once again on a sample basis. And for these bombs, we should tie our checking to the purchases. Okay, so the purchases would have been tested. So now in respect of these items, we should check as to what all changes have taken place in respect of the rates which are there. So if the rates are increasing or decreasing, that will give us an insight about the costs in respect of those bombs, which would have changed period on period. Yeah, very, very important procedure, but generally it's ignored by the auditors. Another procedure, and which is generally performed but not appropriately, happens to be the analytical procedures. Now, in respect of COGS, analytical procedures can be performed. Now, what could be the analytical procedures? There are a lot of analytical procedures which are involved, and this is not really limited to COGS. One can say this is all about the costs which are there in the organization and which also are directly linked to the production process. Now, one is of course the COGS. Similarly, if we talk about a manufacturing company, power and fuel happens to be an important component. Power and fuel happens to be an important component of the cost in respect of such type of organizations. Now, let's think about all of these types of costs, and I'll just take an example of this power and fuel. Now, if one were to audit this power and fuel, so how can we really audit this? We need to understand the cost driver against any cost. Okay, so now as regards the power and fuel, now if we were to audit this power and fuel, so now if in the current year this power and fuel cost has gone up, so what could be the reasons for this? Once again, we need to understand this by splitting this cost into two parts. One is the quantity, second is the rate. Because if the power is consumed, then quantity is involved and rate is also involved. If no rate has changed in the current year in relation to this power and fuel, then what does it mean? That the quantity which has been consumed has increased in the current year. Now, this quantity could have been increased due to two reasons. One, the production has gone up. So if the production has gone up, so definitely the quantity will be more. Correct? Now, the other reason could be the inefficiency. So now it may happen that in the current year, the quantity has increased by 10%, whereas eventually the production has remained same. And what could be the reason for that? That could be because of the increase in inefficiency which is there in the current year as compared to the previous year. Yeah. And similarly, the rates are also required to be checked. Now, how do we check this? Now, for this, what did we do? We looked at the cost driver. So what did we discuss? We discussed that against each and every cost in the statement of P&L, one should first check. And I'm just generally talking about the statement of P&L now. I'm not just trying to keep myself limited to this particular area. For each particular type of cost, one should check what are the cost drivers. What are the cost drivers? So now if there is a cost driver, one should check whether the cost is in line with the cost driver or not. So if the cost is moving in line with the cost driver, that will again give us an insight. Now, once again, another example which we can pick up for this could be about the sales commission. Okay, again, nothing to do with this particular cost, sales commission. Now, for sales commission, when we go and understand from the management, what did we discuss? So we understand that commission is required to be paid on sales which are achieved. So that means in the current year, if the sales will increase, then the commission cost is going to increase. If the sales will decrease, then definitely the commission cost is going to decrease. So that means for this sales commission, what is the cost driver? Sales. Yeah. So now these cost drivers are very, very important to be understood. Because with the help of these cost drivers, one will be easily able to appreciate the audit procedure. Yeah. Yes or no? And for these cost drivers to be understood, I'll just go back to what we started discussing. That was all about the understanding of the process or understanding of the activity which is there on the part of the management. Because if that is not obtained appropriately, then definitely the audit procedure which will be applied, that is not going to have much impact, or that may not be, one can say, appropriate in the circumstances. Moving further, talking about another important area in respect of the manufacturing organization, and that has to be property, plant, equipment, as well as capital work in progress. Now, generally, what do you find? Generally, we find that the manufacturing sector is capital intensive. Yeah, generally you will find that, because for this manufacturing activity to be performed, capex is required. Capex is nothing but this PPE base. Okay, and that's why it's capital intensive generally. And this is what attaches some challenges in respect of these areas which become important on the part of the auditor. Let's try to discuss those challenges now, and let's try to discuss as to how do we address those challenges as an auditor. So I'll talk about first challenge, and that is about the new capex, or one can say this capitalization which could be going on. Say for example, an organization is coming up with a plant, so they are setting up a plant. Now, setting up of a plant will involve a lot of things. Let's try to understand what are those things going to be. So one is the procurement of land. Second is about the construction of the building, or you can say the construction of the factory building. Then the procurement of the machinery. Yeah, means this entire infrastructure which will be involved in the manufacturing process, that is nothing but is called as capex. Okay, and till the time this entire infrastructure is in place, wherein this PPE becomes ready for use, what do we call it as? We call it as capital work in progress. Means it's getting capitalized, but it's work in progress. It's not ready for use. Okay. Now, let's try to understand as to what could be the challenges in this capex. First challenge would be the cost component. Now, cost component is important to be understood here. And what are going to be those cost components? For this, we need to go back to the requirements of the accounting standards. We need to understand the requirements of the accounting standard as to what can form capex or what can really form PPE. Okay. Now, basis the definition of the accounting standard, the cost which is directly attributable or the cost in relation to PP is something which can be capitalized, provided it is expected to be used for more than 12 months. Yeah, that is what the definition of PPE says. And this definition is something which is there under both the gaps, Indian gap and India. If we pick up both, so they are like same now. Yeah. So now as an auditor, it becomes important for the auditor to make sure that the cost components which the management is capitalizing is reviewed in an appropriate manner. Another challenge which generally arises in respect of the capex is about the classification. See, generally, when the management will be in the process of this capitalization, so what they can do is, and they generally want to do is, they will just put this entire cost, which could be in relation to the plant and machinery, which could be, let's suppose, at times related to office equipment, which could be at times related to furniture and fixture. These all may be mixed up. Okay, they may not be having a proper categorization for this. Why? Because they may say that this is all in CWIP stage till the time this is not really capitalized in the form of PP. So we are just putting it at one place, and which may form challenge. Why? Because eventually this has to go to the right classification when this becomes PP, and which may bring in a lot of challenges. Why? Because this capitalization process may take at times couple of years, or at times 3 years. So that's why it's important that this classification is taken care of by the management in an appropriate manner throughout this process which they have been carrying out. The second aspect as around this capex happens to be its aging. Now this is a big challenge, and this is a very risky area in respect of audit. At times, what do you see? That the company got a project, which was kept as CWIP, but that was put on hold for some time. And the company started another project that was then sort of made a priority by the management. And once again, that was put on hold. Okay, then the management came up with a third project, and first two projects are still on hold. So similarly, management may be having numerous projects and which have been lying under CWIP, say for 2 years, 3 years, or more than 1 year, more than 6 months. And every time you go and talk to the management, what do they say? They say that yes, we have a plan in place wherein these projects will be revived, but these have not been abandoned. Okay, so these are very much active. It's just that the priority has changed currently. So that's why we are focusing on these latest projects now. But what is the risk now? The risk could be that first two projects or the old projects which are lying as CWIP may have actually got abandoned, and which are therefore required to be impaired. Yeah, but this impact is not coming out in the financial statements. Now for this, it becomes very, very important for the auditor to understand appropriately the nature of those projects. Auditor needs to understand the plan of the management, and this discussion has to go to the level of those charged with governance. So this is not something which will remain limited to the CFO or maybe the accountant of the company. Yeah, so this has to be something which needs to be discussed at the topmost level of the organization, and the auditor needs to question and challenge the management in terms of this capitalization which has been put on hold. Okay, auditor needs to review the board minutes. Auditor needs to review the minutes of the committee meetings which have been taking place, because that will also give us insights to the auditor as regards the developments or as regards the plans which the management may be having in respect of all of these projects. And if these have been lying idle, auditor needs to question the management in terms of the impairment which could be involved in respect of all of these projects. So that's why I would say another very, very important area when it comes to the audit of the financial statements of a manufacturing company particularly. Another area is about the audit of major overhaul, or one can say major repair. Now, When we talk about major overhaul, now once again, we need to look at the requirements of the accounting standard. Now, accounting standard requires major overhaul as one of the component of the PPE. Now, one must understand the fact that it requires this PPE to be understood as one of the component of the PPE. Okay. Now, what does it mean? That when we talk about major overhaul, major repairs, so this is not something which will form part of P&L. This is something which has to be capitalized and which has to be amortized over the period of its occurrence. Yeah. So now if one has to go by the requirements of the accounting standard, how do we really audit this? Now this again needs to be checked by the auditor. So now what are the ways through which auditor can pick this, and what are the things which the auditor needs to review in respect of getting to all of these items? One, the repair and maintenance happens to be very, very important area. Yeah, so this ledger scrutiny, thorough assessment of this particular area in the financial statements is important. Why? Because there could be a lot of costs which are required to be capitalized, but which have actually been charged off, which is forming part of repair and maintenance. Similarly, when it comes to the capex, or when it comes to the additions which are there in the PPE, it becomes important for the auditor to review them thoroughly. Why? Because some of the costs which may have been capitalized, some of the items which may have been capitalized could be in the nature of those which are required to be charged off immediately, or which are required to be just taken to P&L. Yeah. So this application of the accounting standard needs to be understood. And when it comes to the major overhaul or the major repair, let us just quickly understand this principle. Now, this accounting standard requires that if there is any major overhaul, so if we talk about, say for example, a cement company, yeah, so if you talk about a cement sector, so in their case it's very common to have an overhauling of the plant every 3 years, every 5 years, wherein significant expenditure is involved. Now one has to understand the period of its occurrence. And how will the auditor get to understand about it? One, auditor will know the process, auditor will know the technicalities which is involved by talking to the relevant teams. Now, who are going to be the relevant teams? The plant team, means the factory people. It could be about the discussions with the plant head. Okay, it could be about discussions with the corporate office at times. Okay, wherein the auditor will get to understand about such type of costs which are required to occur at regular intervals, but which are not going to be so frequent that they are occurred on a daily basis or on a monthly basis, because we are talking about only those costs which are going to occur after 1 year. Okay, say every 2 years, every 3 years, because that is something which will form part of the component of PPE. And if at all there are any such components, yeah, which are there and which have not been capitalized, it becomes important for the auditor to make sure, talk to the management and make sure that these are capitalized. Why? Because this is again going to have an impact on the P&L. And these are some of the ways through which this manipulation is also possible. Yeah. So that's why it's again something which becomes very, very important on the part of the auditor to make sure these things are really taken care of. Another area, though not always relevant, but again could be of relevance, happens to be the fair valuation. Yeah, so at times, because the PPE, the quantum of this PPE, or as we discussed, that the manufacturing companies generally happen to be capital intensive. So at times, what do you see? Some of the organizations may have chosen fair valuation in respect of some of the items of the PPE. So if at all this fair valuation has been chosen, so now the audit of the fair valuation is important. And what is this fair valuation? Fair valuation is nothing but an estimate. So that's why we need to look at the requirements of the auditing standard in respect of estimates. Now, what is an estimate? estimate, one can say, is something which is based on approximation. Yeah, wherein things are not 100% accurate. It's all based on approximation. That's an estimate. And therefore, these are subject to changes. And these are also required to be reviewed on a regular basis. Okay. So now when it comes to the fair valuation, what is important? The, if we talk about audit today, a significant focus of the reviewers happens to be on those areas wherein the estimates are involved, wherein significant judgments are involved. So that's why these are very, very important, very, very critical areas. And one can say from audit's perspective also, these are very, very risky areas. So that's why one has to apply his judgment, one has to apply his expertise, and one has to make sure that all the requirements of auditing standards have been taken care of. Now, what could be the other requirement of the auditing standard which needs to be applied here? Now, fair valuation is something which would be performed by an expert most of the time. And who will that expert be? That will be the expert of the management. Now, that expert could be in-house or that expert could be external to the management. It could be either way around. It doesn't really matter whether that is in-house or external. What is important on the part of the auditor is that because this area could be such wherein the expertise is involved, then similar to what we discussed in case of stock take, if you remember, yeah, for inventory physical verification, we discussed that if an expert is required, what is it that the auditor needs to do? Auditor may also be required to involve his own expert. Or if the auditor believes he is not required to involve his own expert, he cannot just simply go by whatever the management has given in terms of the report of his expert. No. So auditor needs to make sure that all the workings, all of those reports, all of those areas on which the workings are performed by the expert, whether that is that of the management or whether that is that of the auditor, is really understood and which is really taken care of by the audit partner also. Why? Because eventually it all comes down to the responsibility of the audit. Yeah. And who has the responsibility? This responsibility lies with the audit team, or one can say the audit partner. Yeah. So again, very, very important area which one needs to look at. And particularly in respect of this CWIP. Now, in fact, if you look at some of the reporting requirements that we have in the financial statements, this aging of CWIP is just something which is introduced. This aging of CWIP is something which is also required to be now looked at, reviewed. Why? Again, because of the challenge we just discussed. And one of the ways through which the manipulation is possible on the part of the management. So to address all of these type of risks, it's important that the auditor takes care of these areas. Yeah, so very, very important areas in respect of the manufacturing sector particularly. Okay, now moving further, we can just also talk about one of the area which especially arises in respect of the manufacturing sector, and that is in respect of sales. Now, generally, what do you find? Generally, we find that the sales take place, and in respect of sales, a warranty is also involved. Yeah, generally, okay, in respect of this sector. Now, how do we really deal with this warranty is again important. Why? Because this is going to have an impact on the financial statements. One, in terms of the cost which is involved, and second, in terms of the revenue which is recognized. Now, if one has to go by the requirements of the accounting standard, if one has to go by the requirements of the Ind AS, so now warranty can again be of two types. Yeah. So now, first of all, let's understand about the warranty, and then let's understand about these two types of warranties. Now, what is a warranty? Goods have been sold, the the terms which are attached with the sale involve that if the good is, if there is any, let's suppose, so sort of defect in the goods which have been sold or the product which has been sold, then the customer can come to the company, say for next 6 months, next 1 year, next 2 years, next 3 years, yeah, depending on the arrangement which is there, and the company will be required to make good this defect. Okay, this is something which we call as warranty. Yeah, we all understand about it. Now, as regards this warranty, let's try to understand what are the costs or what is the obligation on the part of the entity. Now, entity has got obligation in respect of cost, which could be of two types. Let's suppose when the product is found to be defective, maybe some part is required to be replaced. Okay, so that will involve replacement cost number one. Or if nothing is required to be replaced, the manpower is going to be involved who will make good that defect. Okay, so that means entity will definitely incur some cost, right? Now, when it comes to the audit, now what is important? Whenever this revenue is audited, auditor needs to make sure that the terms of the contract are understood appropriately. Yeah, so the review of the agreements becomes important. So one has to be the discussion with the management. That means about the understanding of the sales process, similar to what we did in case of procurement process. Two will be about the risks and the controls which are involved in this particular process, similar to what we have discussed. Third, when it comes to the testing, in respect of that testing, the sample which will be picked up, yeah, so all of those samples are required to be looked at in a way that if there are such type of arrangements which are involved, these are understood by the auditor. Okay, because at times what may happen is that the management has been selling goods which involve a warranty, but nothing has been done in respect of warranty. Means no accounting is done. So that's a risk which auditor needs to take care of. And the first step for doing that will be the understanding of these arrangements. Okay, so this is first part. The second arrangement or the second procedure on the part of the auditor will be to understand the type of warranty it is. Now, warranty could be of two types if we go by the requirements of Ind AS. One is called as assurance type warranty. Now, what is assurance type warranty? Let's suppose if you go and buy a car. So there is a warranty which is attached to this for 3 years. Okay, so if you go and buy a car and you want to buy this car without a warranty, so will there be any impact on the sales price of the car? The answer is no. So the price remains unchanged. So the price remains unchanged. It doesn't change, right? But let's suppose you go and buy a car wherein the warranty is of 3 years and an extended warranty is also made available. Okay. Now, is there an option available for you to buy this car with a warranty of 3 years only, excluding this extended warranty? The answer is yes. Now, this 3-year warranty, which is sort of fixed, okay, which comes along with the product, is called as assurance type warranty. And this extended warranty is called as service type warranty. Now, if you go by the requirements of the Ind AS, what does it say? That in respect of assurance type warranty, provision of this cost which may arise needs to be recognized. But when it comes to the service type warranty, Ind AS says that the revenue needs to be split into two parts. So how do you split that? One part of the revenue will be in respect of the sale of car, and the other part of revenue will be in respect of the warranty. okay, which is going to arise in the fourth year and fifth year. Yeah, which is also called as a sort of multiple element arrangement. Okay, so now as an auditor, what do? You will first of all understand this arrangement, and then you will obtain the workings from the management, and you will audit those workings. Now, those workings, if they fully capture all of these types of arrangements in terms of the amounts which are recognized in the financial statements, it's good. If some of these are missing, then it becomes important to identify these errors and make sure that these errors are accounted for in an appropriate manner in the financial statements. Yeah. Plus, one has to also understand that this is not only about creation of provisions. It's not limited to the creation of the provisions. It could also have an impact on the revenue. Okay. So maybe the revenue which has been recognized may have to be split, and some part of revenue which is there may have to be deferred. Yeah, so all of these aspects therefore become very important on the part of the auditor, particularly in respect of this manufacturing sector, because in respect of manufacturing sector you come across these terms. Yeah, and it's something which is very common. So when you sell goods to the dealers, so maybe the warranty clause are available over there. Maybe any product is sold. So if you talk about the auto sector, if you talk about any other sector, yeah, so all of these clauses are something which are very common, and it's important on the part of the auditor to make sure that these items are really taken care of. Okay, so I think with this, we can just say that we have sort of discussed some of the key areas or some of the key considerations in respect of manufacturing sector. Now, I would request you to also share your queries and any other points that we can then now discuss. And I would request Anil ji to share any queries from your side, if it all is there, so that we can discuss that.
Thank you, sir. Thank you so much for such a wonderful deliberation on this manufacturing sector audit consideration. I have received certain queries, sir. One query is relating to the inventory valuation. One member is saying that the auditor is not an expert, but is responsible for the audit. Are there any practical tips or procedure to ensure correctness of the expert's report?
See, when it comes to the expert's report, it's very judgmental, honestly speaking. So we cannot definitely have a checklist to just go and tick that. If all of these points are taken care of, then we can say that yes, we are good to go. First of all, the involvement of an expert is a judgmental thing. Yeah, so one has to be very careful in terms of deciding whether the expert, I'm just talking about the auditor's expert, whether the need for auditor's expert is there or not. Because if there is any doubt, it's always appropriate to involve an expert. Why? Because if we are the auditor, so we happen to be the expert of the accounting, or say audit areas, or say the taxation areas, but these industries are such. So if you talk about cement sector, if you talk about say metal sector, so okay, so in fact if you also talk about this oil and gas sector, so we are not really talking about it. These are very technical sector, and some of the material which is involved therein, the nature of these items are such that it's very difficult for accountant or auditor go and physically verify them. So that's why it's always appropriate to engage a team of experts. Okay, so that is the first point. Second point comes that when the team of expert is involved, so how do we make sure that whatever work this expert has performed is good enough? So in that respect, one has to just understand that when we are involving expert, so that expert is nothing but our team, and we should not think that our responsibility is done away with. See, the moment we carry that an expert and don't need to do anything, okay, so automatically I would say this problem arises. So the way to approach this practically, or I should say my tip will be that you should think that even though I have involved this person as an expert, but I need to stay engaged throughout this exercise, throughout this process. Okay, so that's the best way, because if you stay engaged in this entire exercise which this expert is going to perform, then you will eventually get to understand the complexities which are involved, It may not be 100% understood the way it is required to be done, but that will be good enough for you to obtain the comfort. And if that is taken, then you can appropriately document this, and you can always explain in your documentation that this is something which you have also performed along with the expert. And I would say that will be a sort of good enough exercise on your part.
Yes. So basically, physical verification of inventory is the responsibility of the management. The auditors
Yes.
need to review the process and satisfy himself and do test check whenever
Yes.
required.
Correct.
Big companies, physical verification is a continuous process, and within the short time available, the audit is difficult to carry out the process. So, what will be the
Right.
criteria of allocation of such?
See, I think we talked about this. So one must understand again the fact that, see, you're right when it comes to the physical verification of inventory, it's the responsibility of the management. In fact, this entire financial reporting is the responsibility of the management. Now, what is the responsibility of the auditor? It's audit. And for the purposes of audit, what do you find? When you go to this sector, the significant risk area is inventory. So, as an auditor, your significant time will be devoted on this area. Why? Because it's a significant risk area, and if the significant time is not involved in this area, then risk in terms of the audit procedures which are applied. Yeah. So definitely you don't want to take that risk. Point number one. Now comes the point that can we do this 100% physical verification of the inventory? The answer is no. In fact, we cannot do 100% checking not only in terms of inventory but in respect of everything. So we are only required to do a test check. But this test check has to be performed in a way that we are getting a comfort over the entire population. Means when we select a sample, so what is the basis of selecting a sample? That the sample becomes representative of the entire population. So that is the methodology we follow. So same goes our approach. So let's think of a company. Let's suppose a company is all spread out across locations. Okay, so I'll share my experience with you. So there was a large manufacturing company, one of the largest companies in India. So they had these locations. I would say across every city they had one or other as the location. Now comes the point that as an auditor, am I required to physically verify the inventory at every location? The answer is no, not possible. So definitely I'll do ABC analysis. ABC means high ticket items will definitely be focused more. B will be the medium ticket items, and third will be the third category from which I'll pick up a smaller proportion. Then comes the next point that even though I'm just ignoring some of the locations or many locations during my physical verification exercise, can I just keep repeating this every period? The answer is no. So maybe in one quarter, I am picking up 10 locations. Maybe in the next quarter, I'll pick up 5 new locations. Maybe in the next quarter, I'll pick up 5 new locations, so that it becomes a sort of rolling cycle, so that eventually I'll end up checking everything. It may not be in a full financial year, it may be, say, in a period of 2 years, but that will again depend on the comfort that I want to obtain. Yeah. And it all goes on to the understanding of the organization in which I am involved, basis which I'll decide my methodology and I'll decide my extent of testing. So it all comes down to the extent of testing. But for you to say that this is the responsibility of the management, I'll just go and I'll just spend, say, 1 hour, or I'll just spend, say, 4 and 5 years, will not be an appropriate answer. It may happen that as an auditor, you are required to spend 15 days on the physical verification process, and which is something actually happens. So I'll tell you, at one of our clients, we spent approximately 30 to 45 days on the physical verification of the inventory. Why? Because the size was such of the organization, the nature was such, and the complexity was huge. And this was a significant area which cannot be involved. Yeah. So we are not saying that this entire period that we spent, the management was also involved. The management was spending, say, 3 months or 4 months on this. Why? Because the quantum was significant. Okay. So Again, the point remains the same, that our testing is going to be limited, but limited doesn't mean that I'll decide my number of hours. One has to be flexible, because audit is
Okay.
all about judgmental, wherein you need to be flexible. So you can saying that I'll spend only 1 hour or few hours.
Yes. Sir, one member is saying, as we have already discussed the peer valuation, expert valuation report, he's saying how far it will be good, or how far will it be to depends on the expert valuation report.
See, as an auditor, we definitely cannot depend on this. So when I say depend, we cannot place reliance on this. Now, it's a technical term, placing reliance. See, one has to understand that we are engaging an expert. Now, engagement of an expert means that expert is going to assist us. Now, if I am the audit partner, I'll have a team, say, of 10 persons who is going to be involved on the audit process. Along with these 10 persons, let's suppose I plan to involve 3 more experts. So now my team becomes a team of 13 persons along with. At the end of the day, whose responsibility is there? I am the audit partner. I am going to sign the financial statements. I am going to sign the audit report. That's why the end responsibility for the audit is on the audit partner. Now, when you involve an expert, so you will do an exercise, you will do your diligence, that is that expert good enough to perform this exercise or not? And if that expert is good enough, so you'll definitely be using him. Okay, so he's going to assist you, but your thought process has to be very clear that eventually the responsibility has to be yours. Reliance doesn't mean that in your audit report you cannot just go and say that this was the person who audited this area and that's why I'm not responsible. Okay, so it goes on to any other thing. So tomorrow, let's suppose if any reviewer picks up and he will ask you anything, so who is going to be the responsible person for this? Will it be the audit team, which may form part of, say, some of the interns or some of the qualified chartered accountants or some of the paid assistants? No, it has to be the audit partner. So same goes with the understanding of the auditor's expert. So we are going to place reliance on him, but with the understanding that end responsibility has to be that of the audit partner only.
Yes. So next is, can we capitalize the manpower cost engaged in regular production?
See, when you say that a person is involved in regular production, then if the same person is also involved in any other activity, okay, I'm just saying, let's suppose this person is involved in 2 plants, plant 1 and plant 2. So this person then needs to segregate his cost into 2 parts. The cost which is spent on plant 1 or project 1 and the project 2. And that should be the basis of the allocation. And this is something which most of the organizations actually do today. So if you look at the corporate office cost, many organizations, you will find they will allocate some component of the corporate cost. Why? Because they will say that our CFO is actually involved to a certain extent on the plant. Our MD is involved to a certain extent on the plant, which may or may not be appropriate. One has to evaluate that. But yes, the basis will be the time involvement. So one has to go through that, and this involvement again needs to be understood. Okay, and wherein we need to apply our audit procedures, we need to actually check, we need to test that as to how is he involved in this. So is he 10% involved on project A and 90% on project 2? So check it. Okay, in the timesheets there must be some mechanism wherein he will have to note it down that these are the hours he has spent on project A and these are the hours he has spent on project B.
Sir, how to means allocate the depreciation of building or inventory? What will be the criteria of allocation?
I would say it's very simple, because if the building wherein the production process is going on, no other activity is taking place. Why? Because this entire building is used for production process. And the entire depreciation of this building will go to the production process. But if let's suppose we are in a building wherein two floors, wherein let's suppose there are five floors, two floors are involved for production process or any other activity, then the depreciation, that means 2 by 5. I am assuming the area to be same on every floor. Then the depreciation for two floors will go to the production process or to the production cost, and remaining to the areas for which those are being used.
Yes. Sir, what can be the effect of the valuation of inventory if company is not maintaining work in progress WIP in the books of accounts? How much is it important?
See, it's not necessary that the company will be always having work in progress. Though in most of the cases, in case of a manufacturing company, you will find that work in progress is in place. Now, to answer your question, there could be two situations. One, the work in progress is actually not there. So if it is not there, actually there is absolutely no problem. The second situation is wherein the work in progress is there, but the management has not put it down in the financial statements. So that's an error. That's an error.
Yes.
So that needs to be evaluated by the auditor in terms of the materiality which is involved. I assume that such error will generally be significant. Why? Because if you talk about any of the item related to inventory, this will generally be significant, because the nature of this item is such. I'm just talking in the context of manufacturing sector. And if this is an error and this is material, then we understand this needs to be accounted for by the management. And if it is not done, then there are going to be reporting implications on the part of the auditor, which cannot be ignored at all, because it's a classification
Yes.
problem. Even though
Yes.
if you look at the amount, so one can say the P&L impact is not going to arise, or one can say the impact on the balance sheet is not going to be there. But in terms of the classification, it's a significant gap. So classification error is also something is important. Yeah, because if you look at the requirements of accounting standard, I'll just go to the basic principles of the accounting standards. There are four criterias which are important: recognition, measurement, presentation, and disclosure. Now, as an auditor, as an accountant, generally we focus on principles: recognition and measurement. Presentation is generally ignored by us. We don't care about presentation. Now, what is this presentation? This is nothing but the classification. And disclosure is the most effective item, in the sense nobody bothers about disclosures. But one has to understand that there are organizations which have got qualified audit report. Why? Because the disclosures were missing. And this is what the auditing standards also require. So if you look at the requirements of auditing standards, they require the auditor to qualify the financial statements if the disclosures are missing. Yeah, so one cannot ignore the importance of the classification in the financial statements.
The last question, sir, whether interest on custom duty retention, which is basically a finance cost, is to be levied on inventory or can be recognized as finance cost as loading over the inventory impact here, gross profit.
See, interest on custom duty, I'm not sure as to why this interest on custom duty will arise. Are you using the correct term, interest on custom duty? It is?
Yes.
So I have not really dealt with this interest on custom duty. But if there is any nature of this interest which is levied, I'm just assuming that this could be in the nature of demurrage. Yeah, demurrage is something which is abnormal cost, and that is incurred because the material is lying at the cargo or at the terminal, which has not been picked up by the management in the available time manner, and that is when this demurrage cost arises, which happens to be an abnormal component, and any abnormal cost is not allowed to be capitalized. And I'm assuming this interest cost to be abnormal because I have not really dealt with this interest in the normal course of the context of this and any type of activity. So again, you need to evaluate. I'm sure this has to be an abnormal item, but if you believe this to be normal, only then this can be loaded. Otherwise, this cannot be loaded to the cost of the inventory, irrespective of the quantum which is involved. Because if you have asked this question, I'm sure the amount is going to be significant, because whenever it comes to demurrage, the amount involved happens to be significant.
I hope connection is gone.
to P&L and you will charge it off.
Yes. Thank you so much, sir. Now we come to an end. You have covered all the questions relating to this our today's deliberation. On behalf of
Thank you,
Auditing
Anil.
and Assurance Standard Board of Institute of Chartered Accountants of India, we extend our heartiest thanks towards you once again for sparing your valuable time and enlighten all our members, all our Chartered Accountant fraternity on various intricacies as well as the e-audit consideration on manufacturing sector. Thank you so much, sir. Thank you so much for joining and sparing your valuable time. Thank you so much.
Thank you,
Thank you so
Anil
much, all the members who have joined. Thank you, sir.
Sure. Thank you everyone for your time. Thanks so much. Yeah.